Chaos is coming. I'm your host, Steve Metre, and thanks for joining me today. On our lead story, the Unthinkable is about to plunge the world into the next banking crisis. And this is something that we said on this show was coming. And I want you to understand why it's starting now, what the catalyst behind this is, and why in a matter of months, we're going to be in an all-out, full-blown global banking crisis. Plus, we have a sponsor for today's show. Black Box Stocks is back. Now, I'm really excited about this company because something I didn't tell you yesterday is they're an acquisitions company, and they just made a big one. And on the news today, this brought in a flood of investors that put a floor under the stock, which is now setting up a big upside move of 44%. Not to mention, we're very excited about what this company is likely to announce in the coming months. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's over to Bloomberg, where we picked today's story up with a headline of New York Community Bank Corp plunges as real estate risks start to jolt the market. Now remember, we said this was only a matter of time before the banks started to get hit, because when you constrict the supply of money into the economy, which is what the Federal Reserve is doing, and I'm going to make the case of why this is going to get a whole lot worse in the near term, that eventually it leads to a string of delinquencies and defaults, and everything points right back to the banks, and they're starting to hemorrhage in a big way, and not just in the U.S., as you're about to see all over the world. The firm, which acquired part of Signature Bank last year, stockpiled cash as it contends with lending risk, including a pair of troubled loans for a co-op complex and an office space, as well as stiffer regulation due to its size. The bank's provision for loan losses surged to $552 million. This shocked analysts and shareholders, because what happens is when banks start to believe that loans are not going to get paid on, well, they're the ones that have to eat the loss. They're the ones that lent the money out. So they have to start building what's called a loan loss reserve to pay out when these loans go bad. And the fact that banks are starting to increase their loan loss reserves suggests and indicates directly that they believe that there's going to be an increasing number of loans that are entering delinquency and eventually going into default. And this causes panic from Wall Street, because they believe that the banks, which are supposed to be the solid foundation of our financial system, are really sitting on sand. And all the things they did kind of make sense. They're probably good over the long term, but in the short term, the street doesn't like surprises. That's true. And now they've ripped off the Band-Aid, and they're going to be healing. I don't think the problems get worse from here. This from a Piper Sandler analyst. And here's the deal. The things are going to get much worse in the banking system. One of the problems is everybody believes that what we saw back in March of last year was a one-off event. And what's happening now, they think is just kind of like an aftershock to the earthquake. What they don't understand, and I'm going to make the complete case, is this is just the beginning of what is round two. A matter of months, perhaps in case of March. As we suggested in yesterday's show, we're going to be in an all-out global banking crisis. The stock of the bank fell as much as 46% on Wednesday and was down 38% at the close of New York trading. This is the worst since the deposit run toppled Silicon Valley Bank last March. But hold tight, it's going to get a lot worse, as investors have been trying to gauge the potential fallout for U.S. banks. They held about $2.7 trillion in commercial real estate loans late last year as property values tumbled, and borrowers desperate for new financing face heightened interest rates. And not only that, they're facing banks that don't have the capacity to lend. Financial standards for lending have tightened. They don't want to lend on these properties. The problem is they have no choice. The issue here is the buildings have gone down in value, and the people who hold those buildings, that own them, well, they don't want to pay for that full price. They want to loan at the lesser amount because they need to rent the building out. They need to bring their costs down. The problem is somebody has to eat the loss. Now, normally, the person who owns the building does. The issue here is they set these big buildings up in separately held corporations, and if indeed they need to walk away, well, they do, leaving the banks to hold the bag. And now you're starting to see that this is not just a little problem. It's going to be a systemic one. And what this provision for loans is now 10 times what analysts had estimated, suggesting things in the bank in terms of delinquencies are going to get a lot worse really fast and greater than the firm's total provisions for the prior decade. So you can see here, just as we predicted, when you start to invert these yield curve and money curves and keep them inverted for extended period of time, you constrict the creation of credit. And at some point down the road, it all starts to dry up. The money in the system starts to go away. And next thing you know, there isn't enough money to pay on all the debts and sustain the growth of the economy. And then it all starts to unwind. The firm said it wanted to build up loan loss reserves and be better in line with other banks of its size, not wanting to admit that perhaps a lot of its customers aren't making payments, and to get ahead of potential weakness in the office and multifamily property markets. The amount of the company loans that were 30 to 89 days past due jumped a whopping 48% in the last 3 months of the year. That is a staggering amount. Could you imagine nearly half of their loans now are behind payments? That's not a good sign. If this is just the beginning of the crisis, imagine where we're going to be when we're at the peak of it. It's going to be devastating, and a lot of banks aren't going to survive. The two loans accounted for the bulk of the $185 million in net charge-offs the bank took during the fourth quarter, which also is more than its combined net charge-offs over the past 10 years. And here's the evidence that this is only going to get significantly worse, is because we're looking at the net percentage of domestic banks tightening standards for commercial industrial loans to firms in all sizes. This in blue, and anytime the blue line's over that horizontal black line, on net, banks are tightening lending standards. Now, if you're not familiar with that, what it means is when you go to get a loan, it's just more difficult to the extent where some people just can't qualify anymore, or they realize the bar sets so high that it's not worth it. So when you don't borrow more money from a commercial bank, well, it creates less money in the system, because the only way money is created in our banking system is through commercial lending. It's not the government. The government doesn't create any money when it borrows. And lo and behold, when you constrict the creation of credit, and when you do it long enough, there is the evidence, and it's just very clear that the delinquency rate here you can see in red on all loans at all commercial banks, well, with a lag, it follows that tightening standards. And sure enough, what we're about to see is a big uptick in delinquency rates. And this is something that Wall Street and the political elites have said is not an issue. And what's going to happen is it's going to be an issue all at once, and they're all going to come hemorrhaging. The banks, they're going to be facing some disastrous news. Now, I want you to think at the same time this is going to happen, what is the Fed doing? Well, it's cutting off the bank term funding program. It ends in March. So now all of a sudden you're going to have an issue of a collateral shortage and a cash shortage in the system all at once. It's not going to be pretty. But even insiders don't believe it, as Citizens CEO calls the New York bank here an outlier. Says regional bank pain, well, that's in the past, and that's not the case at all. And it's really important to understand that a lot of these banking elites, they don't even understand how the monetary system works. They may understand how banking works and lending works and standards and all of those wonderful things, but they do not understand the financial system in terms of how the money works. And here's the evidence of that. For the most part, everything's in the rearview mirror now. This one, Van Swan said Thursday in an interview with Bloomberg, last year's surge in interest rates and shift in deposits that contributed to the failure of firms, including Silicon Valley Bank and Signature Bank, have largely been dealt with, he said. So things are starting to feel a lot more normal. So yesterday's announcement on the New York Bank was, well, it was a bit of surprise. I think that's an outlier. But the issue is it's not an outlier at all. That's the problem, because we're still keeping the yield curve and money curves inverted. That means banks are still keeping lending standards tight. They're constricting the creation of credit. And that's what these banking CEOs cannot see, is they're the ones behind the problem here. But it's not them that's the issue. They have no choice, because when short-term rates are higher than long-term rates, well, banks don't make money lending. Yeah, sure, they make them on fees, but that's not enough to stem off all the money they need to make to deal with the loan losses that are coming. But this isn't just a U.S. issue, but it's going to quickly become one, as U.S. property losses trigger a 20% drop in a Japanese bank, Azora. This is a big problem. The fallout in New York is now going around the world. We talked about how Chinese rural banks in the show yesterday were going to face consolidation because they have problems. The U.S. small and mid-sized regional banks, we've talked about how they're in danger. Now we're seeing the catalyst for it. But the issue here is just like the global financial crisis, the rot is spread all over the world. Now, even in the Japanese banking system. As a Tokyo-based bank, Japan's 16th biggest by market value, expects to post a net loss of 28 billion yen for the fiscal year, compared to a previous forecast of a 24 billion yen profit. And the bank recently, as of November, the president said it would likely not need large additional reserves for its U.S. property loans, signaling how some lenders may have underestimated the depth of the market slump. And so this is going to be a problem, because this year is when we start to see a bunch of these commercial property loans start to come due, and the banks have to deal with them. The reality is they can't lend against them because the values have come down. Someone's got to eat the loss. Either the owners, which we know they have no appetite to do so, or the banks, and that's where we get the catalyst for the next global banking crisis. And here we can see Azora said Thursday that that the CEO will step down and be succeeded by the deputy president. That change coming April 1st. But it all comes back to the yield curve and the money curves, because when central bankers drive short-term rates above long-term rates and start to act like they know more than the market forces do, well, again, you cause the banks to stop lending, or significantly, in this case, reduce their lending to the point where there's not enough money to sustain the growth and pay on the existing debt. Something has to give, and we're seeing it happen now. And here you can see the yield curve shown in red against the net percentage of domestic banks tightening standards for commercial loans to firms of all sizes. And what you can see is any time that red line is underneath the horizontal black line, that's when the curve's inverted. And sure enough, that's exactly when the banks start tightening lending standards in a big way. You'll notice as it gets closer to that horizontal black line, where banks really aren't making any money, they start to tighten standards, and the next thing you know, everything breaks loose. All hell comes loose in the banking system. You see it here going to the global financial crisis. You see the prelude here to the pandemic, which was setting up a global recession. Now we see one of the longest inversions since the 1980s. Everyone says it's okay, again, including the banking elites. The reality of the situation is things are not just at the end. This is the beginning of something much worse. As the U.S. commercial real estate market has hit a string of rising borrowing costs that are pummeling valuations. Again, this hasn't even begun to work through the system yet, as office properties in particular have come under pressure since the start of the pandemic, when the rise in remote work chipped away at demand from tenants. Prices for U.S. office in the U.S. have slumped 25% in the 12 months through December. This, according to Green Street. This is something we have not seen before. This has not happened in the past. Usually office valuations are fairly steady. They might fluctuate a little bit, but the broad trend is they continue to go up. So when you see the value of these buildings come down, that means the loans on them either have to be paid down, which of course the owners don't do because they take out interest-only loans on the property. It's really a brilliant move. They put them in a separately held corporation. They put all the risk on the bank, who says valuations can't go down. Well, that is until they do. You want to make the case of why the Fed's getting back to zero at some point. Well, we see it right here coming as the next banking crisis. One people who don't believe that, well, that's the Fed. As Fed's Powell cements pivot, but pushes back on timing of the cuts, saying, well, there's no need to do them now. Perhaps we'll see him in March. And we're not declaring victory at all, because Powell can't even see. And that's why I want to talk about what's going on in the banking system, because Powell stands on his podium and cannot see what's going on around him. This is the same issue that Janet Yellen couldn't see, the housing crisis in her own backyard going on, and she said everything was A-okay. And this is exactly the problem here, because what we're going to see in a matter of months, when this banking crisis gets out of hand again, Powell will be up on his podium, and you'll watch. He'll say, I just didn't see this coming, but it should have been obvious. At least it is to us. And here we can see he said we need more data to confirm a sustained downtrend in inflation. I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting, well, perhaps there'll be another reason. Could be that your banks are going to be failing, Mr. Chairman. And it's a highly consequential decision to start the process of dialing back the restriction. And we want to get that right because, well, we have to seek perfection here. And in terms of this, we either watch the economy explode and then implode upon itself, or we do the right thing and maybe start getting that curve inverted. Nope, not a chance. They want to see inflation come down. Well, Mr. Chairman, you're about to see it come down in a massive way in the coming months because as we come back to the creation of money in the financial system, as we look at the net percentage of domestic banks, tightening standards to firms of all sizes here. Again, anytime over the horizontal black line, that blue line says banks are originating fewer loans. These standards are getting tighter here. And look at the consumer price index in red. Eventually, you can see it still rises early on in the trend, but at some point, it gives way to the fact that there isn't enough money in the system to support the growth and targets for the economy. And next thing you know, demand comes crashing down. There isn't just any money to support the demand component, and you see it happen every time. And that, my friends, is coming. Now, in a matter of months, we should see that data because what I didn't tell you at the beginning of the show is there's something that gives us a very clear picture that this is about to bloom into an all-out crisis. It has everything to do with the beginning of the Fed tightening lending standards, but there's another effect, and there's one thing that both the political elites and the central elites said there's absolutely no way this could happen. And now it is. And that means the labor market's going to go. This from, of course, the Challenger Gray and Christmas report today saying that in January, surging layoffs in tech and financial sectors as cost-cutting and AIs are having a growing impact. U.S. employers announced 82,307 cuts. This is pre-announced layoffs. 136% increase from the 34,800 announced just the prior month. It's down 20% from the cuts in the same month of 2023. But get this, with the exception of last January's total. This is the highest number of job cuts announced in January since January 2009, when 241,749 cuts were announced at the first of that year. Of course, you remember that was when we're in the depths of a financial crisis. Here we're seeing the beginning of it. The labor market is going because when you don't have enough money to sustain growth, you don't have demand. If you don't have demand, you don't need employees. And that's where the whole thing starts to fall apart, particularly for the banks. And here we can see it in the weekly claims. Look at initial claims up a mere 9,000 to 224,000, still historically low. But look at the non-seasonally adjusted. They jumped to 261,000, now suggesting that, hey, you start getting over 250,000 initial claims, you've got problems. But look at this. If we go to continued claims, they jumped 70,000. This on the seasonally adjusted to 1.898 million Americans on unemployment officially. And how about this? The non-seasonally adjusted numbers jumped almost double that by 133,000 to 2.187 million. This is danger zone because when you think about it, people on unemployment have less money because their checks aren't the same. They have less. And what do they have to deal with? High inflation, high debt service, costs. It's all here. They have less money to spend in the discretionary economy. It starts to backfeed itself into, of course, more layoffs. The only good news in this report, the fact that total claims edged down 67,000. But let's talk about how this ends badly for the banks, because as continued claims start to edge higher, which we now know are going to head that direction, that happens because, again, there isn't enough money to support the economy. It's not enough being created. And you can see this trend. Every time the banks start to tighten lending standards with some sort of lag, in this case, not much of one, you start to see claims rise. The only difference is we haven't seen them sustainably rise this time, but get ready, that's coming. And what's going to hit the banks then is when we look at just the consumer side. When we talk about commercial real estate causing a huge problem for the banks, but what about the consumers? Well, look at this. As continued claims go up, guess what consumers don't have the money to do? It's pay on their debt. And sure enough, here you can see the delinquency rate on consumer loans trending higher every time continued claims go up, suggesting the banks are about to be hit with a double storm, not just from the consumer, but the commercial real estate part on top of it. And that's setting up an outright disaster. You can see why chaos is indeed coming. But one place chaos isn't coming for, and that is a sponsor for our show today, Black Box Stocks. Now remember, they're an acquisition company. Get ready, because in the months to come, we believe there's going to be a lot of exciting news about them, including their announcement today. As I mentioned at the beginning of the show, brought in a huge amount of investors that saw this news, put a massive floor underneath their stock. Now, if you trade stocks, you know when volume spikes and it brings price movements to a halt, the next move is big to the upside. Show you why we think that could be 44%. You find them on the NASDAQ under the symbol BLBX. Here we see they announced their acquisition target of EV Tech Aluminum and receives a new $67 million long-term supply contract. This today from Jaguar Land Rover. This is huge news. And here you can see that the new contract adds to their existing order book of $780 million. This is amazing. And the parts supplied by EV Tech will be used in the new Jaguar electric vehicles to be introduced in 2025. And we know that, of course, there's going to be a lot more of EV and hybrid vehicles on the market. There is demand out there for them. Governments are pushing this technology. And as you can see, EV Tech is a leader in that space. And now, of course, they are a part of Black Box Stocks as a brand new acquisition here. You see the contract is expected to provide over $67 million in new sales for EV Tech over the contract period, including aftermarket and model life extensions. Jaguar's new line of luxury vehicles are to include a four-door GT and a luxury sedan. They're both expected to have a range of over 435 miles and capable of fast charging 200 miles in a mere 15 minutes, which is rather impressive. As I mentioned, EV Tech is recognized as one of the world's leading advanced aluminum castings and machine manufacturers, supplying premium brand original equipment makers. It supplies a range of strategic auto parts on powertrain and EV packs, as well as body-in-white structural parts from its world-class facilities in the UK, and this is a huge acquisition for Black Box Stocks. And here we can see from the CEO, Gus Kepler, he noted that we're pleased about the growing order book at EV Tech as we work together to complete our merger. We continue to believe this merger will provide significant value to our shareholders as we enhance and grow the fintech operations of Black Box in parallel with this new business combination. And of course, that means even more exciting things coming from Black Box. We're looking forward to what that is, which is why we wanted to bring this to you early. And it makes perfect sense as shareholders on this news came in and bought big today, put a floor underneath the stock. Here's, you can see the chart. It came down and hammered into the volume supply zone here at the 6-month window, and a huge spike in volume that even as recorded, more buyers are stepping in the stock. Of course, we know that once all the sellers are exhausted and the buyers here putting in a floor, it sets up the catalyst for the next big move. That, we believe, is 44% to the upside, which again is why we wanted to bring this opportunity to you early, because again, we're excited about where this company is going. Again, you can find them on the NASDAQ under the symbol BLBX. And as always, with any company we feature on this show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.